For part 2 of our discussion on current liabilities, we're going to look at accounts payable. Now, what is accounts payable? Well, those are balances, values, dollars that we owe to vendors for the goods, services, and supplies that we've purchased from those vendors on some sort of credit or an open account. Now, there's a timing lag between the receipt of those goods and services usually and the payment of those items. That is accounts payable. So for services though, we usually incur accounts payable when the invoice is received. So let's say you've got an employee kitchen and the plumbing breaks, you bring in a plumber, they work on it. If they say, oh, I'll send you an invoice, you probably won't record accounts payable until you get that invoice. Whereas goods or merchandise received into your warehouse, let's say you order something, you've got a purchase order that you usually have with that vendor to say, I want to purchase these items at this price. When those items come in, they're recorded even though you don't have an invoice yet. Some systems will record that accounts payable as something called received not invoiced accounts payable. And once the invoice is received, it will go into regular accounts payable. But until you get that invoice, that accounts payable value or amount on your balance sheet for that particular item will be at the purchase order price. That's an important note that accounts payable isn't always at the invoice price. It could be at the purchase order price for just those items that you haven't received an invoice at. So the normal entry in accounting would be to debit or the asset or expense that you purchased, and then credit accounts payable. So now you've got it in there. When are you going to pay that accounts payable? Well, that's where terms come in. You know, most vendors will have an invoice date. They may say pay upon receipt of that invoice, or you might have terms. Those terms refer to an agreement you have with the vendor of what they'll allow as far as waiting for you to pay for that invoice. So what's that time period they would like you to pay that invoice in? So an example of terms would be net 30. So net 30 would mean, hey, please pay that invoice within 30 days of that invoice date. So I've got 30 days to pay it. Some vendors will come up with terms such as 210 net 30 or some other version of this, but what that means is you can get a 2% discount if you pay that invoice within 10 days. If you don't pay it within 10 days, well, then we want you to still pay it within the 30 days of the invoice date. Now, many customers will take advantage of this discount because if you think of 2% over that 30-day period, that would equate to 24% annual savings, which is a pretty big deal. So that's why many companies will really try to take that discount and plan that way. Now, there's another term you have to worry about related to your liability of what you've purchased for merchandise. If you're purchasing something that needs to be shipped all the way across the Pacific Ocean, or the Atlantic Ocean for that matter, these liability terms are very important. So it's something called FOB, or free on board. Free on board indicates whether the buyer or seller is liable for those goods that are damaged or destroyed during shipping. So FOB shipping point, or FOB origin, means that the buyer is at risk and takes ownership of those goods as soon as they leave the seller's location, or as soon as the seller gives them to the shipper to ship to you. Whereas FOB destination means the seller is at risk and takes responsibilities until you receive those goods, or until the buyer has received those goods and they've been delivered. So those are the liability terms you need to be aware of when it comes to an invoice and accounts payable. So let's take a brief overview of QuickBooks and see how accounts payable functions in QuickBooks. All right, let's see if we can enhance our understanding of accounts payable and how it affects the balance sheet, income statement, and the journal entries that would be made for that. So we're going to pretend we own a company called Pizza Palace International. Pizza Palace International, we just started the company. As you'll look at our balance sheet, we put $25,000 of our money into it as an investment. We've got cash of $24,991 because we already spent $9 on some inventory, but we need more inventory to open and start the pizza business. So what we did is we created a purchase order, and that's the first step of the payables process. Requesting a vendor to ship you some goods that you'll eventually pay to them. So in this case, we've got Mike's Mozzarella Warehouse. They sell mozzarella cheese that we would like to put on our pizzas straight out of Wisconsin. And so we put in a purchase order to order 40 pounds, and that's our unit of measure there, 40 pounds of mozzarella bagged cheese. And at $3 per pound, we're planning on spending $120 for that. But you'll see right now we haven't received it yet, but the warehouse has just told us that Mike's Mozzarella truck just pulled up and they're dropping off these 40 pounds of mozzarella. So we're going to receive those and see what that does to our accounting transactions. So today, we have some orders that we want to receive, some purchase orders. So we're going to bring up this purchase order that we just looked at. And today's date is July 2nd. So that's July 2nd. So that's the date we'll receive the goods. And everything came in good. We had the quantity of 40. We could always change it here if we wanted. If we only counted 39 bags and then, dispute that with Mike Mozzarella. But we're going to assume everything's in and everything's okay. It looks good. We're going to add it to our warehouse. And so we'll see what it does to our balance sheet and income statement. So it's been entered. It's received in full, all 40 bags of mozzarella. And you'll notice that now our inventory has gone up to $129 from the original $9 that we had. And you'll see that we now have an accounts payable in our system for the $120. So if we look at our journal entries and refresh those, there is our journal entry for the receipt that we had. So we have debited our food inventory for $120, and we've credited our accounts payable for $120. And we note here that we owe Mike Mozzarella for those received bags of, and it says bill to follow, received bags of mozzarella. So there's our entry, but you'll notice nothing's happened to our profit and loss because we haven't sold anything yet. So it's all in the balance sheet right now. So let's close this, and it looks like we did receive another bill. Yeah, we did receive a Verizon bill, a Verizon wireless bill for our CEO, Jimmy Pepperoni. So Jimmy Pepperoni is paying his first bill for Verizon, so we should probably enter that bill. So in QuickBooks, we'll go to our vendors and we'll enter a bill. And in this bill, we've got Verizon Wireless. The invoice number was 234567890. 234567890. And the amount of the bill was $257.20. Now it says the due date is July 11th, bet on July 11th. And we can just put in there if we wanted to, Jimmy Pepperoni's cell phone. So it is a telephone expense. So there we go. We've got our telephone expense for Jimmy Pepperoni's cell phone. We're going to save that and we'll refresh our transactions. And there we go. We've got a telephone expense as a debit. We've got our accounts payable going up by another $257.20. And we'll look over here on our balance sheet and you'll see that accounts payable has now gone up by that $257. So now we have accounts payable of $377.20. And it affected our net income because that was an expense that we'll be able to deduct So we go over to our income statement, and you'll see we don't have any income yet, but we've got Jimmy's telephone expense on there, and you'll see how that profit and loss amount of $257 came over to our balance sheet in the equity section under net income. Everything is now in balance between our assets and our liabilities and equity. So the system has completed that all for us. One of the things that we'll do is go into our vendor reports and look at our AP aging summary. And when we run that report, we'll see all the outstanding invoices that we have. And it will age it, so we'll see what's current, which are the 2 invoices that we entered today. And you'll see that we have no invoices that are old, but it's important to look at the AP aging to see if there is anything old and outstanding here that needs to be reviewed. These items in this last column would be greater than 90 days. So those would be more than 3 months old. We haven't paid those invoices. And of course, our total at the end ties out to our balance sheet of $377.20. All right, now we'll show the other side of accounts payable when we actually pay it. But I'm going to show you something interesting about systems that they don't really tell you in the books too often. But if we've got vendors, we're going to go pay bills. You'll notice that when we pay bills, only the Verizon Wireless is up there. So you'll see that we owe $257 of bills to pay, yet we have $377 of accounts payable. Well, that's because Mike's Mozzarella hasn't actually sent us an invoice yet. So until we receive an invoice, we're not going to put it into our system, but it's important for good accounting practices that we recognize in our accounts payable here the fact that we did receive that mozzarella cheese and we will eventually owe that money. So that was a received, not invoiced amount that we have in our accounts payable. But we'll go ahead and pay the bill that actually was received. And this is a Verizon Wireless bill. Even though it's not due yet, we're just going to be good about paying our bills and pay them right away. So for today's date, we're going to write a check. We're going to let the check be printed by the system out of our checking account. So we're going to pay that selected invoice. And now what's going to come up is printing the checks. But before we print the check, you'll notice that the system has already taken money out of our checking account and also reduced our accounts payable. So we are still in balance for our assets and our liabilities, but even though we haven't quite printed the check yet, the system is saying you've got it all queued up to print, so it's taking the money out of our checking account and relieving that accounts payable. So if we go over here to our journal entry, well, it wants us to pay the bill, so let's just print that check. We now are printing that check. It's going to ask us, did it come out okay? And yes, it did print okay, so we'll just say, yep, everything was good. Our journal entry should refresh, and we see the paid check to Verizon for Jimmy Pepperoni's cell phone, and our balance sheet has stayed the same, our income statement has stayed the same, but we've now paid that check, reducing our cash and reducing our accounts payable. I hope that gives you an overview of accounts payable, and now you can see the systematic way it works through a system like QuickBooks. Well, I hope that was a helpful overview of accounts payable for our Part 2 segment on current liabilities. I hope you liked this overview. I hope you'll comment down below if there's something else you'd like to see. And remember to subscribe. This is Tim Hungerford. Thanks for listening.